Welcome to Financial Accounting. In this presentation, we'll discuss financial accounting cycle. There are many definitions given for financial accounting by several authors and institutions as well, such as American Accounting Association, Institute of Chartered Accountants of India, and other similar institutions. In the simple terms, financial accounting can be understood as a language of business, which communicates the financial information to all the internal parties and external parties. The internal parties are shareholders, managers, directors, and employees of the company. The external parties are suppliers of raw material, banks and financial institutions, general public, competitors, regulatory authorities, and the tax authorities. Financial accounting gives an input to the financial decision making and facilitate good and valuable financial decisions, which may help in accomplishment of the business goals. There are 4 steps in the process of financial accounting, which are also known as the accounting cycle. These steps are in the following sequence. Number 1, recording of financial transaction in the journal. Number 2, entity-based classification of the financial accounting transactions in the book of ledger. Number 3, summarizing, which includes presentation of and preparation of 3 statements, namely trial balance, income statement, balance sheet. The 4th and the last step in the financial accounting cycle is analysis of financial statement and the interpretation of the results. This video includes only a brief discussion on the steps of financial accounting cycle, but all the steps will be further elaborated in the upcoming videos. The first step in the financial accounting process is recording of the financial transaction in the book of journal. A transaction can be purchase or the sales of the goods, payment for the electricity bills or the wages. The transactions are recorded in the journal as it happens and are recorded in the chronological order, or we can say date-wise recording. After we are done with recording the transactions in the book of journal, it's time to make a separate account for each of the financial entity. This is done for ease of accounting. We can know everything about the financial entity by looking in its account. Say, if I need to know anything about the machinery, I need to look at the machinery account. Every transaction related to machinery are recorded in the assets or the machinery account. Similarly, all transactions related to Mr. Ram are recorded in his account called Ram account, where I can see transactions with Mr. Ram and can know his outstanding balances, either credit or the debit balances. Summarizing. Summarizing is the 3rd step in the process of financial accounting, where income statement and balance sheet are prepared. Before the accountants prepare trial balance, and trial balance is a statement of all the debit and credit balances in the double entry system. The definition of income statement and balance sheet are given in the terminology videos. Analysis of financial statement and interpretation is the last step of the financial accounting cycle. Analysis of financial statement is done using tools such as cash flow analysis, fund flow analysis, trend analysis, and the ratio analysis. Analysis of the financial statement is done in order to know the 4 things: the liquidity position of the business, solvency position of the business, profitability of the business, and the productivity of the business. So this was the brief about the accounting cycle. Thanks for listening.